I wanted to start the video by just noting that in this problem, we worked the first two in class, and I asked you to work part C. There's an inconsistency here in that this salaries amount should be $3,200. So if I didn't announce that in class, it needs to be, that edit is necessary for you to work part C. And then after that, you can look at C, and I'll just work it through here. If you haven't worked it yet, then I would pause the video and work it, and then with this 3,200, and then look at what happens after that. So if I paid $2,700 of salaries and wages in January, that means that I had a payable amount that was paid off with cash, and so my S&W payable would be reduced by that $2,700. So that's one effect that happened. And then I said I accrued additional pay of $3,200 during the month. Well, that accrual would be related to what we incurred as an expense, and that was $3.2K. So those are the two entries that you can gather from part C. Then you just take the ending balance of $800 of your salaries and wages payable. Remember, that is the adjusted balance. So we have a credit amount of $800. We had this journal entry, which increased my salaries payable by $3.2 thousand. And we had this one, which decreased it by $2.7 thousand. And so if you're looking for the beginning balance, then you know that if it increased overall by $500, it must have started at $300. That's the salaries and wages payable balance at 12/31/15, right? This would have been its balance at 1/31/16, January. Okay, so that is, again, very related to what we're talking about with cash and accrual transactions. This visualization is just to show you that accrual information, by virtue of the matching principle and the realization principle, contains expenses that are not timed with this expenditure of money. It contains revenues when we haven't necessarily collected money. But cash information is a part of the total accrual information. So accruals will record when we pay money and recognize an expense at the same time, and pay cash and recognize revenue at the same time. It's just that under accruals, we don't have to time the recognition of these with the exchange of cash, right? We're allowed some distance between those events, either with cash preceding or cash following. We can record the adjustments necessary for an accrual-based information. This being said, we can convert from one to the other, right? If we have cash information, we just have to add in this accrual information to get to accruals. And if we want cash information from accrual information, we just have to strip out these expenses and revenues to get back to cash information. Okay, so they're very much related. Two types of entries I want to talk about are cash to accrual adjustments and then reversing entries. Cash to accrual adjustments are sort of getting it wrong and getting it right. So it is recording everything under a cash basis because you're just doing that during the months of the year or during your reporting period. And then at the end of the year, because you want to switch over to GAAP, you would have to make some other adjustments. So suppose that we paid $36,000 for a 3-year insurance policy. Under accrual, right, we would record this here. We would record the prepaid insurance as an asset for an asset, and then wait to match the expense. Well, under a cash basis system, the company would record it like this. Well, cash went out, so we recorded expense, right? Now, the only thing that would make this acceptable is if there was an end of period adjustment. If at the end of the period, we made an adjustment to these accounts to make them right. And Over here with the prepaid insurance, this is what that adjustment would look like. So we're correcting the fact that we overstated our interest expense. We're reducing it by 24,000 because we only want to show 12,000, right? 36,000 divided by 3 is $12,000 of expense per year. And so in order to get it into that correct term, I would want to credit it by 24,000. If you see here, that would give me the appropriately matched expense. Now, for the prepaid insurance, we didn't record any, but we have 2 years of a policy going forward. We should have an asset for that amount. And so we had nothing. We adjusted by a debit of 24,000. That is the appropriate amount of remaining insurance. So whenever you do a cash basis entry, if you want to convert to an accrual basis entry, you can always do a different sort of adjustment like this. And notice that it'll result in maybe a somewhat odd journal entry because you're not used to crediting an expense, right? The only time you do that is when you're correcting it. And then in the same token, you could be debiting a revenue. So because you're crediting an expense, it might seem a little counterintuitive, but that's what you're adjusting for, right? Reversing entries are a totally different type of entry, and reversals are only done on accruals. I'm not quite sure why companies would choose to do this. Some companies really do. Like I said, they're just kind of silly. The idea is that you accrue something and then you wipe it out at the beginning of the next year. So for example, suppose we had employees working for us. They earn $15,000 over the course of the year, but we don't pay them until the next year. So they earn $15,000, we match it appropriately, and we accrue the payable. It is an accrual transaction because we have not paid. We're recognizing the expense ahead of the payment. Now, this is the end of the year. The expense is closed out and retained earnings is reduced. So we have followed the matching principle. But at the beginning of the next year then, let's say that our employees earn more paydays before they're paid, say from January 1st to 2014, or January 1st to January 4th of the following year, and they get another $1,000. So now they get $16,000. Well, what would have happened is if the company used reversing entries, they would reverse this whole thing by just flipping the debits and the credits. They debit the entire payable. So, right, the payable went down to 0. It had been at 15,000. Well, they debit it at the beginning of the year on January 1st. They zero it out. The expense account, now remember the expense that we recognized in the prior year has already been closed out. So expenses still begin at 0, but we're crediting them by 15,000, which is odd. So now they have a temporary credit balance. But then when we pay on the 4th, we pay $16,000 of cash, we recognize the total salary expense at that point. So we only match 1,000 salary expense from 1/1. That would be our balance at 1/4/16. That would be all we would have at that date, which means that we have appropriately matched our expenses, right? Because we reversed and then we recognized everything again. It's really a little odd. Like I said, why they don't just do this, right, which results in the same thing, but is a little cleaner, I have no idea. Just that's what they do. They don't trust their accountants to remember, oh, hey, I had $15,000 of that expense. That's why I have that payable going forward. Now I can reduce that payable, right? Anyway, that is a reverse entry. And here's some problems you're going to work through class. You can take a stab at them all ahead of time, always a good idea. You can certainly do these two because they follow the two that I posted on that I posted the answers to that are in your Module 3 notes. This one's a little different just because of inventories and payables and cost of goods sold. Those are all related accounts. So that's an interesting problem. A little more difficult maybe, but you can handle it. And then we'll talk about all these in class. I will also be posting some tests for you guys to look at. But again, remember those tests have problems from Chapter 3 and Chapter 4 that I wouldn't expect you to necessarily know at this point. Or not to necessarily, but you wouldn't know at this point. All right.